Hey guys, welcome back to another video. So in today's lesson, we're going to go over smart money concepts and what exactly smart money is. Okay, so right, so smart money is capital that is being controlled or placed in the market by institutional investors, central banks, funds, and other financial professionals. Smart money also refers to the force that influences and moves financial markets, often led by actions of central banks. It is okay, so smart money is invested on a much larger scale than retail investments and is the reason for most movement of price. So on a chart, if I just want to show you quickly here, um, moves like these are smart money driven moves where you see big impulses to the upside or downside, and like sharp impulses. Those are moves that's caused by smart money, right? Moves such as up here where you've got like a small little bit of movement there, those are retail moves, right? So retail moves driven by retail traders, they might see some sort of pattern on one of the lower time frames and obviously get in. But the thing to note here is that retail traders cannot push price for thousands of pips or hundreds of pips. Moves that are big and impulsive are always done by um, institutions, hedge funds, banks, etc. Right? And then the reason for that is because the volume of retail traders make up probably 5 to 10% of the market. Your $1,000, your $10,000, your even $100,000 is not going to move the market. Whereas an institution or a bank or a hedge fund, they are trading volumes such as hundreds of millions, if not billions, of money that's being flooded into the market by these institutions. Hence the reason why you will see such aggressive or impulsive movements in the market. So, okay, let's just go back to my slide. All right, so smart money is invested on a much larger scale than retail investments and is the reason for most movement of price. Smart money is cash invested or wagered by those considered experienced, well-informed, in the know, or all three. There's little evidence to support the notion that smart money investments perform better than non-smart money investments. However, such influxes of cash influence many speculation methods, right? So, like I said, smart money is the reason behind prices' actual movements on the chart. Retail traders pretty much have no say when it comes to these kind of moves and these kind of impulsive behavior in the market. So on the next slide, okay, so smart money is the reason behind sharp movements in the market. These are typical U-turns in the market, right? So these are areas where price tends to U-turn, right? So if we're looking at this chart now, you can see, for example, areas like these. Let me remove this. So areas like these where you can see aggressive movement. So we had aggressive selling happening in this direction, right? And then, so all along here, I just want to highlight that. So here we had aggressive selling happening, right? And then suddenly you see a sharp movement to the upside, right? So in this area, you can see a sharp U-turn in the market, right? You've got an exchange between bearish and bullish, or sellers and buyers, right? So that area there, you can see a sharp exchange we're looking at. So generally, those are U-turns or V's in the market. You'll always see that at these areas where you can spot these V's, that is the areas where smart money is obviously involved, right? So those are the areas of interest to you and I. Likewise, if you look at, so that's an area of interest. So if we're looking at here, for example, again, areas of interest, can you see price sharply rises to the upside, comes back, and then obviously continues its move to the upside. So again, these are the areas of interest. Look, this area here. Once again, you can see selling an exchange between sellers and then aggressive buying happening. Again, sellers, aggressive buying happening. So those are the areas that we would tend to look at, and are potential points of interest to us, right? So wherever you see a U-turn in the market or a sharp V that forms, know that there's bigger players or bigger fish that have currently entered the sea or the market right now. So okay, it is crucial to identify where the market, where the smart money are involved in the market, as these are the areas and zones that are more that these are the most areas. These zones and areas are of the most interest to us when building a case towards your buyers, right? So, like I said, those areas or zones become your point of interest in the market. You know that there's something happening at those areas, and those are areas that you are going to look at for future moves. In this style of trading, we trade alongside the banks and institutions rather than against them, as typical traders tend to do. So retail traders, obviously, they work off patterns and based off what they see, like the trend lines and touches on the trend lines, and all these head and shoulder patterns and whatever other patterns that they look at. They take trades, and often a time you will enter a trade and it will run against you. So you enter, it moves into profit, and then it gives you like $100 or whatever, and you move into profit, and then 2 minutes later the trade reverses on you and kicks you out. And the reason for that is because you keep trading like a retail trader. You need to have a fresh look at this when you're trading SMC, because SMC requires you to trade with an institution. So you identify the moves, identify where the institution has gotten into the trade, and that is exactly where you're going to get in on your trade and trade with the institutions or these banks. And that obviously prevents you from the scenario that I just explained, where you enter a trade and then 2 minutes later it reverses on you. The reason for that, for it reversing on you, we will get into just now. Okay, so knowing where the smart money is involved in the charts makes all the difference from being successful, from being unsuccessful to profitable. So yeah, like I said, when you're in a trade, you will see, like if you're trading these patterns, you notice that price turns against you and kicks you out. And the reason for that is the following. So for example, right? Okay. So we would look at. Right, so on here, you can see that price is obviously in a clear uptrend at the moment. So let's just do it like this. So. Okay, so it's on a clear uptrend at the moment. And this is obviously your higher high, higher low, high, high or low, right? And you would say that, okay, so at these areas, right? So, okay, so this area is where your bank enters the trade, right? So what happens here is at this area, just give me one moment. Okay, so at this area, the bank places both a buy and a sell, right? So that's okay. So your bank will place plus 500 million on the buy, and they will also place a 500 million on the sell. So two trades are taken at this level, right? And the reason for that is I'll explain. I'll get to that now. So, what you need to know is at these U-turns in the market, these investors or hedge funds or institutions or banks will place two contracts. So remember, they don't press buy or sell on MetaTrader, and they don't use any sort of platform. They own physical contracts in the market, right? So these physical contracts are actual contracts which they own, and they anticipate price to get to a certain level, and that's the level that it would get to, right? But they by placing their contract in the market, they place two contracts, so they hedge their trade. One is $500 million or on the buy, and the next is the 500 million on the sell. So at that same level, they place both contracts, right? And then price moves into their direction, right? So because when they place that buy, and retail traders also start buying, it's obviously going to push price. So you're going to look at this area as the break of structure, right? So you know that you're in a clear uptrend, price is continuing bullish, etc., right? So this buy that they place moves up into profit, right? So when they are up here at this level, at that level there, when price is up there, they are now sitting with plus 500 million profit, right? So remember, they took 500 million here on the buy and 500 million on the sell. So they're sitting with another 500 million in profit. So in total, they're sitting with about 1 billion on that buy, right? Equity, 1 billion equity on that buy. Now, at this level, they close off this buy. So they take their profits, right? They take their profits, and by doing so, and by taking their profits, it now creates less volume in this area of the market, right? So now you will start seeing that candles start exhausting, or you'll see rejection candles, pin bars, evening stars, bearish engulfing, etc., right? So on the lower time frames, price will start to exhaust at this area. Why? Because the bank has already closed one of their positions. So yes, they're sitting in 500 million of profit, but at the same time, at that area, they are now sitting in minus 500 million from their sell trade, from this trade here, right? So they're sitting in minus 500. So they're pretty much at break even. So they secured the 500 million profit. They close that. They close that order. They secure the money. The money is in the bank. Is in the bag, right? From there, when everybody starts seeing exhaustion in this area and rejection and candlestick patterns and maybe even chart patterns, you might see the head and shoulders or whatever on your lower time frames there. Retail traders are now manipulated into thinking that price is obviously going to sell, right? So what happens? Retail traders will now start selling and everybody pushes the market down to this level, right? And by doing so, you might see that it will create maybe some sort of trend like this to the downside on the lower time frames, creating liquidity so it created buy side liquidity, right? So by creating this liquidity, you know the price must obviously break out of this to collect all that liquidity. So retail traders now push price back down, and price comes back all the way down to this level here, right? So that was our previous demand level. That was our demand, right? So where we saw aggressive buying happening in this area here. So we had aggressive buying there, becoming our demand level. Price shot up, they closed the 500 million profit. They were sitting in 500 million loss. Retail traders then saw the opportunity and started selling the market. Due to the less volume, price obviously then retraced and dropped all the way back down to the demand, right? The demand, this whole process where price drops back down to this demand level is called mitigation, which we'll touch on a bit later on in the slides. So price comes back down to the demand. And now at this point, your bank can successfully break even on the sell. So they've now closed their sell at zero. So they have not taken a loss, right? Remember, they closed the 500 million profit and they were sitting in 500 million loss up there. But price now has dropped all the way back down to that demand level, right? And by doing so, it lets them out on the sell, right? And everybody is still thinking that, it's still selling because prices maybe in this area you might have had, so we might have had this happen here. So there you might have broken the structure at that level, and everybody's thinking, we're forming a downtrend, prices dropping to the downside, etc., right? But in reality, price is only coming back down to this demand level that sits down here to let the bank out on the sell, so they'll break even, and then they re-enter another buy at this level because they know that that price is going to continue to the upside. That is the real direction of price. It's going to continue to the upside, right? It'll be a little bit more clearer in the next example that I show you guys. But from here, when they enter this, they enter again the plus 500 million, and they just ride this all the way up. Okay, so that is the thinking behind smart money, and how to identify it on the chart. I just want to show you guys one more example. So again, okay. Okay, so there's our demand level here, right? So this is the demand. So that's the demand level. Let's just write that. So that's the demand that obviously broke the structure here, right? So at that area, we had a break of structure. That was a break of structure. And this was the higher high, higher low, higher high, higher low, higher high. Well, this is no longer higher high, so we can call that a high. Well, it's actually on your higher time frame, it will still be a higher, so I'm going to leave it as that. And this area, so these areas are minor structure, right? Where you've got that, 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 that. Those are minor structures. So this becomes the higher low because it's still higher than that low there, right? So as long as we hold that structure, it's still valid, right? And then that's the higher high, it's the higher low, right? So these areas minor structure. So we can see that price has obviously given us a demand level because it's now broken the structure that sits at this area here, right? By seeing a break of structure and the level that caused the break of structure, we know that we are still bullish. So again, the bank will enter so they enter the 500 million on the buy and 500 million on the sell, right? So two contracts placed at that level there. From there, price obviously shoots up. They close their buy at that level, so they close plus 500 more profit. At this level here, right? So they close their plus 500 million profit at that level. They're sitting currently in minus 500 million loss. So they're sitting in minus 500 million loss. And now price gives us minus structure at these levels. So when retail traders start saying, oh, okay, we were bullish, price breaks the structure and it gives us a change. They look at it as, oh, it's broken that structure, so we can see a change in momentum or whatever. They might see a head and shoulders pattern that has now formed. So if you look at this here, you can see that's the first leg. So that's the shoulder. So left shoulder. That's the head. That is the this is the, what you call this? Yeah, there's the right shoulder there. And then price, everybody's expecting that, right? Because you got 1, 2, 3, left shoulder, head, right shoulder, right? So everybody's looking at that as a head and shoulder pattern. Everybody starts selling the market. So they are manipulated into selling the market, but price is not ready to drop. The actual movement is the buy. Why? Because what led to this break of structure here was this demand. That demand was not mitigated, right? So price did not come back and successfully mitigate that demand as yet, meaning that at this point here, the bank still needs to be let out at this point, right? So price must mitigate in order to let the bank out. We had the break of structure. These are minor structure areas. And price comes back down, will drop to this demand level, let them out on the sell. So now the sell, they close, break even. Everybody that is now selling, so if you sold here at this level, right, your stop loss SL is there above that area, right? So your stop loss is there. Everybody's stop loss is in this area here. What happens? Price now turns at our demand level, because we know that this is the demand level. We know that, yes, the bank has closed 500 million profit, but they're going to be let out on the sell at this area. So they break even on the sell and they will re-enter the buy here at that level, right? So buy plus 500 million again, they're going to enter and price will now shoot back up and take out this structure here at that level. So we look at it there, we've got that level. Price will break that structure and continue to the upside. And by doing so, once it breaks this area, it's now taken out all these stop losses here in the market. Everybody that sold on that head and shoulders, price has now taken out all those sellers in the market. Okay, and even if you trailed your stop loss all the way here, when price hits that demand, because that's the demand that pushed price up here. This demand gave that higher high. So price has to continue upward unless it breaks this demand level. Then we would be looking for shorts. Okay, so that's basically understanding and knowing smart money's involvements in the market. Yeah, we'll catch up on the next video.